Hello, this is Market Ready. After presenting the reversal and continuation model, I want to explain these two aspects of our entry model uh, in the context of the moving average. Why sometimes we sweep and purge and reverse, sometimes we just continue. So let's take this example for the GPU. So it was September 17th. So we have another session. We have as a session, we have London sweeping the low, then the high, then continuing down. So this is the start of the bearish trend because before that the trend was bullish. You can see here clear bullish trend line. So here we swept Tokyo high before going down. But here we didn't, and we continue down. Let's check it again in the context of the moving average. So the blue one is the 150 moving average, and the black one is the 50 moving average. Let's see what happened. So price was below the two moving averages. It retraces back to both of them and continue down. But this is the first day of the trend. The second day, the trend has become much more stronger, as you can see. So the price retraced only to the 50 moving average, then continue down. My point is, when price is consolidating, as most of you know, the moving average is flat. It has very neutral slope. Try to change the color here. So let's say this is the moving average. This is the 150 moving average, and the black one is the this one will be the 100 moving average. Moving average, simple or exponential, or it doesn't matter. So talking from perspective and logic of price average, moving average. So most of you know that when the price is consolidating, the moving average market condition, moving average has the slope is flat and position is through price, and the two moving averages are stuck together. So when in consolidating market condition, the both moving averages have flat slope. They go through price, and they are stuck. When market started to move, because market doesn't go from 0 to 100 in second, it has condition. When market started to trend, for example, I would say bearish trend in this case, started to have a higher high and higher low. And you can measure, I will tell you how to measure this, the strength of trend. Two things happened. Moving average. So three things happen actually. Average trend in market. So the moving averages, the slope. We start to have average slope like 30 degrees, for example. Let's say, for example, the position clearly above the price in the bearish market and below the price in a bullish market. And the distance, they start moving averages start to separate. We start to see a distance between these moving average, because here they used to be stuck one against the other. You can even see them crossing, stuck, or even this is distance or crossing. And retracement, price retracing to the slowest moving average. What does it mean? It means that the 50 is the fastest and the 150 moving average is the slowest. Once trend starts to when the price starts to trend, the price retrace to the slowest moving average. That's what we have, deeper retracement. When price start to trend strongly, in this case, you're gonna see this. Sorry. So this will be the black, text is white, and this will be the blue. The blue. Text is almost white, yeah. So the blue is the 50, the black is 150. And 150, I can say 20. Let's say 200. Say 50 or even 20, if you like to. Okay, average under market. Now, for the drops, sorry, for the strongly traded market, the slope is sharp, can have even 45 position clearly above the price in bearish market. Distance moving average are clearly separated. Retracement progressing to the fastest moving average. So here price was retracing to the 150 or 200. Here price was retracing to the 20 and 50 moving average. How is it related to our entry model? It's about the reversal and continuation. Why? Let's say this is the daily candle. Here we can expect, and this is Asia session. So the daily candle here will be bearish. So it will be red. Okay? Red. This is the Asian candle. We put it in blue. Just for that. So here we can expect a sweep of Asia high or even previous day high for going down. So here expecting solid or deep retracement, sweeping previous Asia high or even previous day high before continuing down. So here we have Purge and put it up. Purge and reverse. Okay, I want to separate these three market conditions with a vertical line. So I will do this style. Yeah, yeah. Here, continuation, price, and likely to sweep previous time cycle high, not previous day high, not even Asian high. Enter on previous cycle low, break and retest. I had this experience with gold. For a week, gold was having extremely strong trend, and I was always expecting price to sweep the Asian low. Asian low. But price was never coming down. It was always retracing to half or third of Asian range, then going up again. So I spent a week, instead of making thousands of dollars, I spent a week expecting price to retrace. So price likely to see previous time cycle. Not previous day high, not even as you know, until previous cycle. Expect retracement to half or third Asian range until previous cycle break and retest. This is it. And just a small tip, we can measure the strength of a trend by the retracement. In average trend, retracement are deep, strong trend, retracement are short.